What is up, guys? Today we are going to be going over the earnings report over ServiceNow for Q1 2026, and we will decide if it is still a buy. As you can see here, it is one of the positions I hold in my portfolio, and it is one of the stocks on the market that has been going down recently because it is in the software sector. So let's get into it. We have some good news and some decent news from the earnings reports. As you can see here, they have raised the year subscription revenue outlook. And they have also Now Assist, which is one of their businesses, spending over 1 million in annual contract value, grew over 130%. So they're getting bigger numbers on a quantitative scale. Not only that, I saw that they work with Google Cloud and NVIDIA and was named Partner of the Year from Google, which means that a lot of these massive corporations need someone to help them be organized, to function, right? And that's exactly what ServiceNow does. They work more on like the HR side. So we know that massive companies need them and will probably not be going anywhere. They have a massive $2 billion accelerated share repurchase. They've only repurchased around 20 million shares of common stock this quarter and have approximately 4.2 billion remaining to buy. So this will continue driving price up in the future, even though a massive amount of people are selling currently. It's just a short-term sell-off, and I'll get into that a little later. But this buyback will help a little bit in this time, but it will definitely help the company itself in the future because they're getting their buyback on a steal deal price. I would call this earnings report a 6 out of 10. It was not crazy, but it was not bad, right? So you can see here, you've got a 22% total revenue increase. They did have a 46 and 44% increase on cost of revenues or subscriptions and professional services, which isn't crazy. As you can see, these numbers are so small that even though they did go up 46%, it is a smaller number compared to this massive billion-dollar number, which went up 22%. But you do need to keep in mind that they did technically, this is the main reason why it was a lower tiered report, because the expenses were 1% higher than the profit. Anytime you have expenses bigger than the profit, that is not really good, right? Rule number one is have more money than you spend more money. So their income from operations was 17% and their gross profit was 16%. Their taxes, they got slammed on taxes this year with a 115% increase. Usually when they have slammed numbers on taxes, it's like a one-off and it worsens the numbers for the earnings report on this specific quarter, but usually it does not happen all the time. So that probably means the earnings reports in the future are going to look a little better, but don't quote me on that. The balance sheet is looking pretty decent. They have a good cash and cash equivalent along with long-term marketable securities. And they do still hold a lot of long-term debt, but as you can see here, their number of total liabilities is getting better along with long-term liabilities. So they're not doing terrible on the balance sheet. They're actually a pretty healthy company. As what we just went over, I really don't know if a 12% down move right after earnings or that earnings report was deserved. Personally, if I didn't own the stock, I would now, because $89 is well under what this company is worth. It is a consistent 20% per year company that can grow every single time. And I'll show you the history later in this video, but this is a extremely consistent company. So for them to be selling it off, which I'll also tell you guys why it's selling off, so that you're not just buying in blind. But I will personally say 13% down after the numbers we just saw is a way overreacted. I mean, look at it. All we saw was a plus 1% on the income from revenue. And I mean, to be fair, they did go up a decent amount when it comes to subscription cost and other services, but we've seen way worse when it comes to a earnings report. So I honestly don't think this is 100% deserved. I would say a 2 or 3% is deserved, but 13% is way oversold. In the short term if you're a short-term trader. So this is how I look at it. Honestly, I think anything under 120 is a good deal, and under 90 is practically like stealing the stock. Like you're practically stealing part of the company. Yesterday it was at 103, and today it is around $89. So we are under that practically stealing line. The last time you even got near there was in 2022 when the market was going down all year. The company's only gotten healthier. It's never missed an earnings report. Or actually, I think that just means it had earnings. I don't think this tells you if it missed it or not. But it is way healthier and way bigger compared to the numbers that we had in 2022. And you're getting it at the same price, which is a still deal. Like it is crazy how good of a deal that is. They service over 85% of the Fortune 500. Like they're not going anywhere, guys. All kinds of massive corporations use them. We're talking a ton of them. If we're over 85% of the Fortune 500 companies, we're talking they're servicing hundreds of thousands of workers. I mean, these companies are massive. So it's not any small little feat to do this, right? They're like top 5 in their sector, right? I don't know, and don't have a bunch of information when it comes to their competition, but I can guarantee you that they are not going anywhere. And I'll show you later that they have a renew rate, which is crazy. They have a crazy renew rate, or resubscription rate. They are growing when it comes to a number of customers with $5 million. So this is also important when it comes to big deals that they have. The greater amount that they have on big deals, the more money they make, right? They're not going to make a bunch of money if they have 10,000 deals with $100,000, right? When you start getting into like 5 million plus deals, when they start getting those in a quantitative spot, that's when they start making the bank, right? Think about it. You have 630 times 5 million. That's a bunch of money they're sitting on. So that is obviously really good news. And this is what I was going to show you, the renew rate. Look at this renew rate. That means that they are extremely sticky. That means that the stock has been selling off since Q4 2025. We've only seen it gone down 1%, which looks like it's irregular. So nobody is instantaneously not renewing on ServiceNow. So as of now, the sell-off on this stock specifically is like kind of random, in my opinion. And I'll show you more throughout this whole video so that you have a good grasp on it. But we're not getting any type of affections or swayed results from this renew rate from AI. Like it hasn't changed anything so far, and probably won't well into the future. I definitely own a position of this, and I have around 5.5% in the account, and I have been DCAing down. So I probably will end up, as you can see here, I only have a couple positions at the point that it's at now. I'll probably end up adding a couple more. I mean, it's high as $200, and that should be around, it should be around 180 right now. After that, not market crash, but dip. So the sell-off right now is way overdone. It's honestly never been on a sell like this. Think about it, like 15% down in one day. And the earnings report that I just showed you wasn't that bad. There's been no real affection of or effect of AI on this company, and probably won't be. To sum up why the stock is selling, right? And I have a slide on this later, but People think that AI is going to uproot these types of businesses. And it will on some of them. It will completely uproot some businesses. But let's be completely honest here. A corporation that's this sticky, that has everything already set up, why would you, as NVIDIA or Google, move or switch or quit ServiceNow, who has already automated everything on your back end, to go to a different company which was made by AI, or let's say make it themselves by AI, right? There's a reason why they hired ServiceNow, right? They don't want to waste time on the back end of things. They want to spend the most time making their product the best product they could possibly be. So why are they going to spend time making an AI to replace ServiceNow? It just doesn't make sense to me. Even if someone else made an AI version of ServiceNow, what doesn't make sense is nobody would trade or quit ServiceNow just because it's an AI version. ServiceNow is incorporating AI. They are incorporating AI themselves. So, in my opinion, this is one of the silliest sell-offs I could imagine, and I'm going to take as much as I can from this. And if it's going to continue going down, I'm going to continue buying it because this just does not make sense to me. Same thing with CRM, Adobe, and Intuit. All four of these stocks are being sold off and are at almost all-time lows for a year just because of what I just told you. They think AI is going to replace Salesforce? Are you kidding me? They literally have an AI agent. They've made their agent and are testing it right now. These companies are intertwined with AI. Adobe, I believe their AI version is Butterfly. They literally have an AI art model. I'm not really sure on Intuit, but you don't really need a lot of AI to file your taxes. So a lot of these companies I don't see being affected by AI in the way that everyone else does. And this is exactly what I was talking about. The software stocks are falling today due to a combination of renewed fear surrounding artificial intelligence, disruption, poor earnings report, and a shift in market sentiment on SaaS stocks. Poor earning reports? Are you serious? We were only down like 1% in a important manner towards revenue and cost. Like the earning report wasn't even that bad. For something to sell off the way it has, 50, 60%, poor earning report has to be like a 3 out of 10 instead of a 6 out of 10. So I think this is a dramatic move from the market, and that is exactly how you make money. Entering yourself in a dramatic move of the market. Oh, I'm sorry. I might have kept you guys in full screen. So here's the slide to that. Pause it if you want to read it. Feel free to. And there's definitely a pattern that you could see within the market, right? You can clearly see that SaaS stocks are selling off way faster than any other section. So this is also a sign to me that this is an over-exaggeration within this sector. I mean, there's no real reason why IBM should be down 10%, Salesforce should be down 8%, Intuit 7%, Adobe 8%, ServiceNow 14%, over fears of AI. A lot of those companies have AI. Meta down 2%, which has already pretty much gone down, but they have a different problem with overspending. So, I mean, if we really were worried about AI, we'd see all kinds of companies going down, like all over the place. It would not just be the SaaS area affected, right? So this, in my opinion, is extremely, you could say, biased or sectionalized. I don't think this is deserved at all. And I think that you are getting massive opportunities on stocks that have not had this type of opportunity for a long time. Well, gentlemen, let me see if I didn't miss a slide. Okay, perfect. You really have to think about the short term versus your long term, right? In the short term, the stocks are selling off 60% for an AI fear. But in the long term, I'm almost dead certain, 98% certain, that ServiceNow is going to be here years and decades into the future, continuously servicing over 60% of the Fortune 500. And I don't think that AI is going to change that because ServiceNow has AI. It was in a slide earlier. See if I can find it. I'm pretty sure I put it in. Okay, I did not put it in, but on the earnings report, it actually did say that they had multiple different versions of AI incorporated into ServiceNow. So I don't think this company is going anywhere. I think it is a massive buy right now, and I think that you should at least start getting some of the stock right now. I mean, look at the price on this sucker. Oh, wrong way. Right here. Look at that. It was at around $240 at the all-time high. It's at $90 right now. We're talking about a 2x from all-time highs, right? We're talking about it losing around 60%. We're down 60% from AI fears, and the numbers are not even that bad. They're still consistently growing 20%. Absolutely crazy, insane to me. But some people will miss it, some people will be scared, and other people will grab at the opportunity. And um, I hope you guys research into this and decide if you want to grab at the opportunity. And I definitely will, and will continue to be, even if it goes down to 20. I will continue grabbing at the opportunity. So that will be all for today. ServiceNow did not have a terrible earnings report. It was actually quite decent, and it is still a big buy for me. I'm honestly going to grab as many shares as I can under $90 as possible. Within reason, you do have to diversify your portfolio. But that will be it for today, gentlemen and ladies. Thank you for joining me, and feel free to subscribe if you thought this content was valuable. I'll see you in the next